Hello students, this is Professor Vincent Osaga, and this is part 3 of chapter 13 presentations, current liabilities and contingencies. The last time we left off in part 2 by talking about the accounting rules of current maturities of a long-term debt. Now let's take a look at the applications of some of those rules by using this illustration. So on December 31st, 2014, a company had $1.2 million of short-term debt in the form of notes payable due February 2nd, 2015. So that is 2 months after the end of the accounting year, the $1.2 million is due. On January 21st, 2015, the company issued $25,000 shares of its common stock of $36 per share, receiving $900,000 proceeds after brokerage fees and other costs of issuance. On February 2nd, 2015, the proceeds from the stock sale, supplemented by an additional $300,000 cash, as used to liquidate the $1.2 million debt. So on December 31st, 2014, the balance sheet is issued on February 22nd, January 23rd, 2015. The question is, how do we show the $1.2 million of short-term debt that is due 2 months after the end of the accounting year, given this situation? So let's take a look at how this plays out. December 31st, 2014 is the end of the accounting year. The $1.2 million classification is the issue. So let's take a look at, on January 21st, we issued stock of $900,000 and we received a proceed of that much, with the intention of using that to pay off the at least a portion of the $1.2 million obligation. So the liability is actually paid off on February the 2nd. The financial statement or the financial statements are issued, specifically the balance sheet, on February the 23rd. Now let's take a look at the application of these rules and how these rules played out. I recall the $300,000 cash that was used to settle a portion of the $1.2 million was part of our current asset. So at the end of 2014, that $300,000 has to be considered or classified as current liability. However, the $900,000, which result from the proceed of selling our stock, has to be considered as a long-term debt. Now, so the total liabilities here will be $1.2 million. Now let me go back and refresh your memory with the rule that is connected to this. So let's take a look at what they said here. They said we should exclude long-term debt maturing currently. In other words, we should exclude those debts from current liabilities if they are to be, look at number 3, converted into common stock or refinanced or retired from the proceeds of new debt issued. In this case, they were retired from the proceeds of the common stock that we issued. So therefore, the $900,000 of the $1.2 million was excluded from current liabilities. Hence, we have $300,000 is being considered as current liability, and the other $900,000 as long-term. So the $900,000 at the end of the year was not considered as current maturities of long-term debt that need to be classified as current liability. So moving along, let's take a look at another type of current liability. Here, dividends payable. So this is number 5 example of current liability. So what is dividend? What is dividends, by the way? We said that dividend comes from the profit or net income, or a portion of the net income or net profit that the company distribute to the owners of the company. So it is actually the net income or the profit. We used to call it profit, but the official name is net income. So the company is just giving a portion of it or all of it to the owners. When that happens, we just give it another fancy name. We call it a dividend. When the board of directors make an official announcement that they are paying dividend to stockholders, then at that point in time, the company is obligated. It becomes an obligation for the company, and we call that dividends payable, and it is usually paid within 1 year or within the operating cycle of the company. So generally paid within 3 months. Undeclared dividends, here are some of the rules you need to know. We said that undeclared dividends on cumulative preferred stock not recognized as a liability. What does that mean? That means if the board of directors did not declare dividends on cumulative preferred stock, you remember the definition of cumulative preferred stock? You can check that out. Then they should not be recognized as a liability. Now, we also said that dividend payable in the form of additional shares of stock are reported in stockholders' equity, not under current liability. So let's take a look at another example of current liability. Here we have customer advances and deposit. So this is the number 6 example of current liability. Now let's take a look at let's take a look at some of the rules. Returnable cash deposit refused from customers and employees. A typical example of this would be you receive X amount of dollars. We receive X amount of dollars in advance from customers. When we receive the money, it is an obligation. It is a liability until we actually perform our part of the bargain. So to guarantee performance of a contract or service, we sometimes receive them as guarantees to cover payment of expected future obligations, may be classified as current or long-term liabilities. Okay. So for example, if you have a bad credit, sometimes some utilities companies will ask you to have a deposit, okay, security deposit. So that would be an example of customer advances and deposit. This, for the security company, that security deposit is considered as a liability. All right. Again, it could be classified as current or long-term liability depending on the situation. So moving along, here is number 7 example of current liability, unearned revenues. I think I slightly talked about this just a few minutes ago. Unearned revenues. Those are the amount that we receive from our customers ahead of time until we actually provide services for them. So this is slightly different from the previous example, which is customer advances and deposit. So here are some of the examples of unearned revenues. Magazine subscription. So we receive X amount of dollars from a bunch of customers and for magazine subscription. When we receive that money, we debit cash and credit unearned revenue. And unearned revenue is classified as current liability until we actually perform our part of the bargain before we make an adjustment to reduce the unearned revenue and recognize the revenue. We talked about this extensively in Principles of Accounting. Here is an application of that. Here, All State University sells 10,000 season football tickets at $50 each for its 5-game home schedule. All State University records the sale of season tickets as follows. So when they receive the amount, they debit cash for $500,000 and they credit unearned sales revenue for $500,000 until the obligation is met. So then at the end of one particular season, $100,000 of the $500,000 have been earned. So we debit unearned sales revenue. We make an adjustment at the end of the accounting period and debit unearned sales revenue to reduce the liability and credit the sales revenue. Moving along, here is another example of a current liability. This is sales taxes payable. Now, as you if you are a retailer in most states, for for those states that have sales tax, and if you are a retailer, you become a collection agent for the government. So for example, if you have a retail shop and you sell clothes, when customers walk in and buy clothes, the state of Illinois expects you to withhold, to charge your customer or collect sales tax from your customer. So you buy a beautiful dress for $100. Sales tax rate is 9%. So you wind up paying $109 to the retailer. In this case, assuming that all of us have a retail shop in Chicago. So when we receive the $109 from customers, the $100 belongs to us, the $9 belongs to the government. But we are holding on to the $109. So that $9 is a current liability until we send it to the government. All right. So we have to consider it and classify it in our record as sales tax payable, another current liability. This is a common mistake that is made in practice. A lot of individuals out there, especially small businesses, will recognize the $109 as income or revenue, but in actuality, only $100 is sales revenue. Now let's take a look at the application of sales tax payable. Look at what happened here. So the company sold $3,000 sale of $6,000 when the property tax is in effect. So they received $3,120. The company received $3,120. The sales revenue is $3,000. The sales tax payable is $1,800 based on this example. So the sales tax payable is a current liability until it is remitted to the government. Now, here is another situation. Sometimes we actually would, some companies actually would receive the total amount and debit their cash and credit their sales revenue for the total amount. At the end of the accounting period, they make adjustment to back out the sales tax component of the total amount. All right. So moving along, let's take a look at another example: income tax payable. Income tax payable is the number 9 example of current liability. What does that mean? You know, as you already know by now, we have different type of taxes. Okay, the government impose different type of taxes on us. I think at this point in time, we are going to cut off at this point and start part 4 of the presentation later on.